as ever, the front end of the yield curve is where to look to see what the bond market is pricing in for future central bank policy moves. So, since this time last year in the US, we had an inversion of the yield curve, which basically means short-dated yields are yielding you more or providing you more return than longer-dated yields. The UK followed around summer in last year, and then Europe further into the autumn. So essentially what it means is you can get nearly as much yield investing at the short end of the yield curve as you can further out in Europe. And price action last year, you look at what happened to longer dated bonds last year, you can see that they get hurt a lot more when interest rates rise than the bonds at the front end. So for a very small drop in yield, you can get much safer bonds. Well, I run M&G short-dated fixed income strategies, and so floating rate notes work really well for us for these types of funds because they allow you to take credit risk without taking any real interest rate risk. And then a subsector of that floating rate market is asset-backed securities. And in some sectors in asset-backed securities, we're finding you can pick up bonds, AAA bonds, with similar spreads to that of BBB unsecured corporates. Another area that's looked attractive to us for a while has been financials. They've been trading cheap to equivalent credit-rated corporate bonds for a while, and we have a preference for higher quality, national champion type banks, and if you can get higher spreads on those than you can on equivalent rated corporates, again, that makes a lot of sense.